Uh, we
Uh,
got lab, and
is
then
there a 4-month-old in your life, or where'd that come from?
no, he was telling me that he didn't shave last time, so he was just telling me that you look more organized than I am, and so we started chatting about it. But then we asked everyone where they're from.
Yeah, yeah, yeah.
Uh,
Yeah, we've got people trickling in, so we'll say that. We'll say that at some point. Always good to see who's who. I feel like I've done what, 4 of these now, and see a lot of the same names, but always good to hear from people. But yeah, we'll give it about. Usually we give it about 2 or 3 minutes. I don't want to waste people's time, but we want to see everybody get in. We had a record number of reservations this time, so want to make sure everybody gets a chance to check this out. While we're waiting for everyone to trickle in, I will make a plug for the YouTube channel. We not only will you get a recording of the presentation if you've registered and shown up here, or even if you haven't shown up, but we chop this up and put it up on YouTube on our channel, which has been taking off. You all are coming and checking it out, so definitely do that. Maybe we can throw that up as a banner. I don't remember if we don't. Maybe Guido can put a banner up with our YouTube link at some point. We'll give everybody another 45 seconds to get here. In the meantime, I see the numbers getting up there, so I'll ask now, who's here? Feel free to chime in the chat. Let us know where you're from. Let us know if you're here for you or on behalf of your clients. We usually see a good mix of financial advisors, CPAs, lawyers, and our clients, many of whom we know well, others are just getting started. So we'll keep an eye. Liz, I see you there. Good to see your name again from New York. Becca from Austin. I was just putting together. I handle the marketing website, and I was just putting together a map of the states where we have clients and the states where we have partners. And I, by the end, realized that it was kind of a silly map because the answer is basically everywhere. Having a map that leaves out one random state, 1 or 2 random states doesn't really say much. Stephen from Fort Wayne. Alan Pence, good to see your name. So yeah, I guess we're now 3 minutes in, so let's get started. John, an EA in training. That's fun. We're always talking to new EAs. Delaware, we've got the entire country covered. All right, so let's get started. We are here today to talk about oil and gas. We've spoken so far about capital gains tax planning through charitable remainder trusts. We've talked about solar for ordinary income. We've talked about estate planning with crummy trusts and various other strategies. We've talked about QSBS planning. Today, it's oil and gas. So you've got me and Farhan here. We've both been here before, but just as a refresher, I'm Jeff. I'm part of the founding team at Valur, and I nominally run our product development process. I'm also a lawyer by background. I don't wear that hat formally with Valur, but if you have questions that border on the legal, if you have questions about the regulations or the Internal Revenue Code, I can do my best to answer. And then we've got Farhan here, who is a senior account executive. He's really the first point of contact that many of you have when you're coming in to talk about oil and gas, solar, other ordinary income strategies, as well as others. So we thought it'd be good to have him on here to talk about this a little bit. So the agenda, really quick, we're going to give you some context here. This is new to many of you. I feel like solar has penetrated a little bit into the popular consciousness, the zeitgeist with the Inflation Reduction Act, and with us having brought it now to hundreds of clients. Oil and gas maybe gets less attention, but it is a really powerful strategy. So we'll give you some context behind that. We'll talk about, as always, the benefits and trade-offs, of which there are some. And then we'll give you a case study. We'll leave time for Q&A, but so far when we've been doing these things, it's been best and we've found it helpful just to answer questions as they come. So don't hesitate to chime in. We'll keep an eye on the chat and we will let you know answers as we go. So I started talking about the why or the context. We've talked about other strategies. Solar is a big one for ordinary income, and oil and gas is also geared toward ordinary income. It comes along with a set of deductions, which we'll talk about, and returns that don't really depend on the type of income. But what we find is that most clients and most advisors and their clients are here looking at oil and gas and solar to focus on reducing their ordinary income tax. Very quickly, as I think many of you know, Valur helps across the board here. We're not only about ordinary income. As I said, we've done presentations on and we have strategies for ordinary income, capital gains, QSBS planning, and estate tax. We're going to focus today on ordinary income. So why are we talking about oil and gas? The major distinction here is between solar and oil and gas. Many of you were here for the solar presentation. You understand that that's a good strategy. So why are we suggesting that oil and gas might be valuable either in addition to or in place of solar? It really comes down to two things: the kind of distinction between active and passive income, and then timing. So Farhan, do you want to maybe talk about active and passive income a little bit?
Yeah. So thank you, Jeff. So the rule of thumb here is that you need active losses coming from any business you set up to write off your active income, and passive losses to offset passive income. Now, the distinction here between solar and oil and gases or any other business you do, with solar, you have to put in certain amount of hours, which is minimum 100 hours, to become active in your entity. So you could take those credits and depreciation and use them against your active income. It's like any other thing. If you go in real estate, you have to put in certain amount of hours to become real estate professional and take that depreciation, use it against your active income. Now, the distinction here is with the difference here is with, and the value proposition of oil and gas is that it doesn't require you to spend any hours in it. You're able to take the depreciation deduction and can use it against active income. We'll talk about the specifics of how can that be done. But the value prop is that you are not putting any hours in and you're using the deduction against your ordinary income. Now, assuming the time that we have left in the year, there aren't many options. If you pick solar, you have to put in those hours. The project has to achieve mechanical completion. There are a few other things. It's a slightly lengthy process to get to the finish line of this. Where on the oil and gas, if you have a busy schedule, if you think you cannot get to it, but you still have a high tax bill and you want to do something, then oil and gas is in place to make sure that can be executed within a timely manner.
That's right. And just to amplify, this really comes down to two things. One, oil and gas may be a viable alternative or an interesting alternative for you and your clients throughout the year because it's less intensive than solar. The returns are going to be good. We'll talk about them. They're maybe modestly lower than solar, but they don't require 100 hours. You don't need to set up a special purpose entity for oil and gas. You can just invest in the fund within days. Oil and gas is easier. It also, as Farhan said, applies to both active and passive income kind of without all of the rigmarole. And that all combines not only to make oil and gas an interesting alternative just on its own, but especially at this time of year when many of you, I'm looking at the names here, and I know that we have a lot of viewers who haven't chimed in yet. Solar it's getting tight to the point where it may already be too late to do solar this year. I'm not going to rule it out entirely, and if you're interested in solar, we should still talk about it. But given the need to complete a solar project by the end of the year and to get your 100 hours in, it may not be viable. And in that case, oil and gas is absolutely better than the kind of tax naive strategy of just paying your taxes. So that's why we're focused on oil and gas right now. It's easier, it's quicker, and at this time of year, it may be the only game in town. So it's worth looking into. Some context around this. Much of this will be familiar to you all. It's the same old story. Congress wanted to encourage energy production as well as the states. And the way they do that typically is with incentives. Sometimes that's incentives for investment. Other times that's tax incentives. The tax incentives here are the name of the game. So both the federal and many state governments offer big tax incentives to drill for oil and gas, and various funds have built ways to pass those incentives on to you. Why is oil and gas all of a sudden, it feels like, a bit of a bigger thing? Well, it's always been positive ROI. We have articles that you can find on our knowledge library that show you the historical returns from oil and gas, and they are significantly positive. But today, the expected returns, and importantly, the range of expected returns, is generally higher because of improvements in the technology around this drilling. This isn't going to be a technical seminar. I'm not going to go too deep into the technology around drilling for oil and gas. You all have heard some of these terms. Fracking is one technology that has increased the amount of product that can be drawn from these wells. But in general, the technology has improved to the point that the cost has gone down and the expected production has gone up, while also the variance in production has gone down. So there aren't as many dry wells. We'll talk about the risks of this sort of thing in a bit, but in general, the returns are expected now to be higher than they used to be, to the point where you're now seeing oil and gas with the tax incentives and the production of oil, and we'll talk about this, outperform the S&P significantly.
Just a short context here in terms of technological advancements. 10 years from now, the odds of you drill it and finding an oil was around somewhere 40. But right now, with the passage of time, as Jeff has mentioned, that has gone significantly better. It's currently 85% odds that once you're going to drill it, you would be able to find oil. So the production and the oil price has significantly got better with the passage of time. But the point here is that the production of, if these are very big funds, and these are hundreds of oil wells. So if the odds are that you're going to find oil in 40% of them, the ROI goes significantly down because the cash flow depends on the production of oil. And the odds are getting better. It's 85% now, which means it's more than double that you are going to get more production and get more money out of it.
Yeah, that's right. And we will go into this in a minute. We'll talk about the step-by-step, how you invest and where the returns come from. But that's the big picture. Just looking at the chat for a second, John, you asked, is this for offsetting active income only? I'm going to touch on the other questions in a minute, but I want to hit that one because we've already actually kind of passed this point. The answer is no, you can use this to offset both active and passive income. The benefit here is that you can offset active income without material participation, but you can always use this to offset passive income. So that's no concern. And as long as we're here, Jay asked, is this for accredited investors only? I'll use that as a segue to talk about this slide. The answer is going to be yes. You have to be an accredited investor. So who's a fit for this? There are rules of thumb. As many of you have heard us talk about, there's no hard and fast rules here. And we have clients at both ends of the spectrum on all of the strategies that we offer. We have trusts that are as small as $60,000. We have trusts that are as large as $400 million. We have solar clients who are making as little as $100,000 a year. And we have solar clients who are making $12 million a year. With oil and gas, again, there's no hard and fast rule. If you're making $100,000 a year, you may decide you want to pursue this for the returns plus the modest tax savings. But what we find is that in general, the folks who are most interested in and excited about this are high income earners. And we're setting a pretty low bar there. We're talking about people earning, let's say, $300,000 per year. That could be earned income from a W-2 job, RSUs from a tech job. It could be business earnings from a business that you run, if you're a business owner or a professional who owns their own practice, let's say a doctor, a dentist, a lawyer. But it can offset any kind of income. Praful asked, can we use this to offset our IRA to Roth conversion? The answer is yes. That's just another kind of income. And the point here, and we'll talk about this in detail, oil and gas is throwing off depreciation. Depreciation is a deduction that anyone can use against any type of income. There are some limitations that we'll talk about, but if you have income, then this can help. Who's especially a fit? Well, at this time of year, it's everybody. Everyone who has that kind of income. Solar may be off the table, so this is great. Even if it's earlier in the year, though, if you're someone who doesn't want to spend 100 hours on material participation, or who doesn't want the regulatory headache of keeping track of that sort of thing, then oil and gas might be a fit for you even earlier in the year. Yeah, you want to talk about it?
One thing I want to add. So we get a lot of people who are on H-1B visa and they are interested in solar, but they cannot execute solar because they cannot set up another entity and put hours into it. So oil and gas here is the right fit for them, so they can take advantage of something that can be easily executed, and they don't have to set up any entity, as you mentioned, and they don't have to put in any hours. Now, who's not a fit? So very clearly, not an accredited investor. That's very important. You have to be an accredited investor to be a part of this. And the second point is individual who have already used up their depreciation benefits. Now, with oil and gas, as Jeff has mentioned, there are no credits. It's depreciation that's coming. Now, the depreciation, when you are writing off earned income W-2, you are subject to this thing called access business loss limitation, which is 305K. So you can write off, if you're single, you can write off 305K worth of income in a single calendar year. Or if you're married filing jointly, then you can write off 610K worth of income in a single calendar year, which means other than the charitable deductions, all the deductions that you take from different venues, solar, oil, and gas combined, you cannot take more than 610K worth of losses. So the limitation here is if someone is thinking, they have $1 million worth of income and they can get a $900,000 worth of deduction, well, that's not possible. The constraint here is that you are limited. If you are writing off W-2, I want to specifically call out, if you are a business owner, you have active business income, you're not subject to that. But if you are writing off active income W-2, then you are subject to access business loss 610K, which means you cannot take more depreciation than that. So
there are a number of questions here that have to do with kind of types of income and amounts of income. I want to circle back to that, Farhan, in a second. Let's talk about the big picture, and then we'll drill into everything you're talking about, which I think is really useful to double click on. So risks and benefits. I'm just going to talk very high level. Oil and gas is something that is a hybrid between a tax play and a traditional investment. So whereas solar, which many of you have looked at, is mostly about the tax savings, right? If you put in money into solar, probably 2/3 of your return are going to come from tax savings and 1/3 over many years from revenue. With oil and gas, it's more heavily weighted toward the investment side. So what are the benefits? Well, the first one is tax savings. For every dollar that you put into oil and gas, you're going to receive a deduction. We have here greater than 90%. In practice, it's actually usually going to be even greater than 100% for some nuanced regulatory reasons. For every dollar you put in, you're typically going to be able to deduct around $1.07. That's a deduction. So you then need to multiply that by your marginal rate, right? So if you make, let's say, $1 million, and let's say $100,000 to keep it simpler, without those excess business loss limits. If you make $100,000 and you invest $100,000 in oil and gas, you can take a deduction basically equal to your whole income. That's going to save you typically somewhere in the range of 30, 40, 50% of that in tax savings, depending on your marginal rate. If your marginal federal rate is 32% and you're paying tax in a high tax state, let's say it's 8%, then your marginal rate is 40, which means for every dollar you can deduct, you're saving 40 cents. So with oil and gas, if you put in $100,000, you're typically getting about half of that back as tax savings right away. That goes to two things that I want to talk about. One is, I'm just looking back at the questions here. Where'd this one go? Capital gains. Are capital gains another category separate from active and passive? No, the capital gains are treated the same, so you can write them off. How valuable oil and gas is will be affected by the character of your income to the extent that your marginal rate is different, right? If you're taking $100,000 deduction, against capital gains, well, you're saving maybe 20% in taxes, maybe 30% in high tax states. Whereas if you're using it to write off ordinary income, you're saving as much as 50-something%. So that does matter, but you can use it against either. So tax savings are the first big benefit. The second big benefit, and actually in terms of total size, bigger benefit here, is the investment return. This is, in addition to being a tax move, also a traditional investment. You're putting money into a fund that is investing in a portfolio of oil and gas wells. And whether you outperform the market or not depends in part on how that investment performs. You're setting a floor on your return equal to your tax savings, right? So if you put in 100, and this goes to someone's question who asked about principal. I'm not, is the principal safe? That was Praful. Is the principal safe? Well, it's going into an investment like any other, but your tax savings are typically going to equal about half of your principal. And so half of your principal is locked in as a return, but the rest of it is going to come from an income stream. We have historical numbers here. As I said, new drilling is likely to yield, and as Farhan talked about, is likely to yield higher returns than historical. But if you look at the historical numbers, you're typically getting back to even combining tax savings and investment returns within the first couple of years. You're then having a long tail of returns as the wells continue to produce over the years. That's going to get smaller and smaller as more of the oil or gas has been pulled out of the well. The production is decreasing. But overall, you're going to yield on average, significant investment returns that are going to add up with the tax savings to beat the market.
Yeah. So just to add more colors to this on the tax savings pieces, as Jeff has mentioned, that if you're putting in $1, you're getting in more than $1 worth of deduction. That's one. The good part here is that you are able to get 90% or more of it in year one. So if you're putting in $1, you can get 90, 92, 93 cents in year one and can use the deduction against your active income. So it's not a straight line. You don't have to wait 10 years or you're getting into $10,000 a year. If you're putting $100,000, you can get $90,000+ worth of deduction and can use it against your ordinary income. It's valuable more, as Jeff has mentioned. It's a higher marginal tax rate if you use it against ordinary income compared to capital gains tax, but it's your choice. On the investment return side of, as Jeff has mentioned, the useful life of these equipment goes on for more than 20 years. They produce cash flow, and for as long as it's economically viable. So the fund wants to make sure that there is a cost of chemicals, extraction, and everything reaches. So they want to make sure if they are extracting oil, it has to be profitable. They're not going out of their pocket. Historically, what we have seen in terms of the cash flow, that other than the depreciation you took, that 90 cents and whatever the delta is, if it's 107, then additional 17 cents. Other than that, you are able to get your money out of it over the course of 4 to 5 years. So cash on cash return, you got the deduction, that's aside. You are able to get your principal out of it. So if that's the case. Now, it depends, oil and gas prices, which is variable, highly volatile, geopolitics and all that. But historically, people have been able to get their principal out of it. Now, as I mentioned, the useful life of the equipment is 20+ years. So you're going to get cash flow for the useful life of the equipment, but it's economical. But the first couple of years are very aggressive. So they extract oil and gas, and the first couple of years are very aggressive, and that's why you are able to get the maximum yield out of it in first couple of years, and then the cash flow goes down as it gets depleted, but it's very high in the first couple of years. No, sorry, Jeff, go ahead. I know.
That's really helpful. There are a couple of questions that go to some of this stuff, so I want to keep talking, and then I'll pull the questions in as we go. Someone asked about whether the income is taxable. Jim asked, why is the return tax-free? And Praful asked, is the income taxable? Those are opposite assumptions. The answer is it's actually mostly taxed with a small deduction. So you see here an income stream. The income is taxable. You get 15% of it is deductible. And so you're going to pay tax on 85% of the income. all of the returns that we'll show you in the calculators, in our case studies, is post-tax and post-fees. So that's already accounted for, but it is taxable income.
Another weird, sorry. Yeah. So another thing here is, so first Jeff mentioned, yes, the first 15% is deductible. If you take a deduction in year one, 90%, you have about 17 cents left over in depreciation deduction that have a 7-year schedule that's going to come from. So if you don't want to use that, deduction against your other income, you could take that deduction and offset the income that has been generated by oil and gas. So if you add it up, it goes around 30-ish%. That is not taxed if you use that deduction, and then the rest of it is taxed.
And let me also pull in Mike's question here, which is related to Farhan. He asks, does it matter when during the year you invest for the deduction? And the answer, right, is no. Your deduction is calendar year. So if you invest anytime this year, you'll get to claim that full deduction this year. Also, I'll pull up one more question. Jim asked, can you carry back? Unfortunately, with oil and gas, the answer is no.
So one thing, Jim, to call out here is depreciation is something that can only go forward. It cannot go backward, whatever it is. Tax credits can go backward, which is not a part of oil and gas, but depreciation from any form of it that I can think of cannot go backward. It can only go forward.
That's right. Jake, I see your question. I'm going to get to it in 1 second. I want to just finish these and then go to the next slide. Other benefits, these are soft and kind of predictable, understandable. We told you there's no material participation or entity set up here. This makes oil and gas much quicker and easier. I'll talk about process on the next slide. And this is a diversification play, right? In addition to the tax savings, this is something that's not typically correlated with the broader markets. And so if you have a diversified portfolio, this is one way to get additional uncorrelated diversification. We want to make sure we spend time talking about risks. Farhan has already talked about the technology and the reduced risk of underperforming wells, but that is the main risk here. There's really not much else, right? Your tax savings are statutory. They're written down. There's not much of a risk there. You don't need to do anything to get those. The big risk is, what if the oil wells underperform? And that's where historical returns can help give you some comfort. The tax savings can help give you additional comfort, right? The floor on this return is pretty high as compared to another risky investment, right? You're going to get half your money back as tax savings. And then the technology has helped make it so that the returns are expected to be higher over time.
And a few things to add here, Jeff. When it comes to risk, there are two pieces of it. So there's tax savings, which is coming in a form of depreciation, and there is cash flow that's coming. Now, the tax savings piece of it, the depreciation that's coming, it's statutory, it's written in the tax code. So completely safe. It's not that IRS is coming back and asking, why did you took it?
And also importantly, Farhan, doesn't depend on performance, right? The wells could be completely dry. You still get your tax savings.
And that question, and thank you for raising this, Jeff, that question has come up a lot in terms of people ask, what if they don't find anything? Well, these are very big funds. We're talking about 9 figures here. And there's a fair amount of diligence and research in place because they have been doing this for a very long time. So this is not their first time. And as Jeff mentioned, it's a diversified portfolio. So it's not one well who's going to be allocated towards Jeff's name. And if they don't find anything, they're just going to come back to Jeff and say, we couldn't find anything. You took the deduction. That's it. Bye-bye. These are hundreds of wells. So fund invest in all together, and these are hundreds of wells. So the odds of not finding anything, it's just significantly, I would say it's 0. They're going to find something. Now, the cash flow depends, like I said, it's volatile based on the oil and gas prices. But, it's not that they're not going to find anything at all. If worst case scenario, they don't, you still got the deduction. You took it, you have more than $1 worth of deduction that you took on this asset. So, yeah.
And then that does take us, I think, to Jake's question. I'm going to talk about step by step, and then I'll address that. So how does this work? We've really gotten to this. It's not complicated. right? In other things that Valur does, we aim to reduce the complexity that historically appeared in these processes. If you're setting up a trust, you had to go hire a lawyer and pay them a bunch of money to draft your trust, and it could have taken months, and you had to send them your information in a Word document. In solar, you would have had to go out and find a developer to do this and pay a lawyer and set this thing up yourself, and we kind of took that all off your plate. Here, there's much less to do, and while we have streamlined the process even further, you could get into oil and gas tomorrow by going through our onboarding and indicating your interest, and we'll get you set up and wired very quickly. That's a material improvement, but there's not a lot to it. So you need to decide on an investment amount, which is something that you can use our calculators for. If you go, Guido, maybe you can put up a link to the calculator. But if you go to our calculator and model this out, you'll find the optimal investment amount. And as soon as we go live with our onboarding for oil and gas, which will be later this week, that calculation will be built in, and we'll tell you, here is the maximum investment that you could make given your income, so that you don't have kind of leftover depreciation. So you pick the investment amount, and that's very straightforward. You can do the maximum or anything less than that. It's totally fine. You invest in the fund. That, again, is straightforward. We connect you with the fund. It's like any other investment fund. You do your diligence. We get you the materials, the prospectus, the pro formas, and you do your diligence, and then you invest very quick. And you get to claim your deduction right away this year. If you do this before December 31st, you can deduct that amount when you do your taxes in April. Then there's the income stream. Again, we've talked about this. You're going to get the income over time. It's going to be an annual return. You get to deduct some of that. And this does go to Jake's question. I'm not going to put it up on the screen because it's long. But the question is kind of, how does the income work? Is there a kind of liquidity preference, or is there some amount that you have to get to, or some extra investment you have to make to access that income? And the answer is no. If you put in $100,000, you own a percentage of the fund that is equivalent to your buy-in, right, as compared to all of the dollars that went into the fund this year. And you get a concomitant percentage of the returns. And it doesn't depend on further investment. It only depends on how much income the fund is making. There's no, on the solar side, we talk about kind of depreciation basis and phantom income and things like that. No such thing here. Once you buy in, what's coming back to you is just a traditional investment return, and it's taxable because it's a yield like a dividend, but it's just there. You don't have to do anything special to get it. So yeah, really very straightforward. I'm just looking at the questions here to see if we're missing anything I can answer. Are we certain the depreciation deduction can be used against portfolio income, specifically capital gains? Farhan, I never want to, putting the lawyer hat on for a second, I never want to say certain. Do you have any reason to doubt that this can be used against income from a capital asset, from a portfolio, from the sale of stock, or?
I can't think of a reason.
Mike, it's a totally fair question, and the answer is yes. This has been vetted with CPAs and lawyers. This is our first year doing oil and gas in any volume, but it has been done for a long time. And I am almost positive, and we can get a final answer. If you want to schedule a call, we can talk about this, and we can pull in our colleagues, that this can be used against capital income, just the same as against.
Kelvin has a question. Is there any depreciation recapture at the end of the life? There isn't. So with these, there isn't any depreciation recapture. So we can go into the nuances, but you cannot transfer the ownership. You become LP in a fund moving forward. So it's just the mail money that's coming to you every year. And then after that, when they close the fund, there is no depreciation.
Yeah, but just to put a bow on it, no depreciation recapture. You're getting to claim your depreciation, and you're free and clear on the tax stuff, and then it's just income going forward. I see. Well, I see Alan's question here, which is a good one. How can we make 12 million a year? I'll leave that to you. If anybody has any ideas, definitely let us know. But let me move on to. We got about 10 minutes left. Keep chiming in with questions. But I think we're on our second to last slide here. Farhan, you want to take on the case study?
So we have a case study here to show you the value proposition of doing an oil and gas compared to nothing. So we have married filing jointly, living in New York, making 600K in earned income. Now, if they don't do anything else, assuming they're in 50% marginal tax rate, they would owe $300,000 in taxes. They have a clock on it till December 31st to do something about it, or they're going to write the money check to Uncle Sam. um Comparison to that, they go and put 200K into oil and gas, where they are able to get around 180K, 150, 185K worth of deduction against your AGI, which means they're gonna first, they're claiming tax savings. So if it's $180,000, for the sake of round numbers, they are able to write off $90,000 worth of taxes. That's one. And they're gonna fall in lower marginal tax rate. That's another one. Now you got the deduction, and then useful based on the the cash flows. There is an income upside to it. So based on historical numbers and 8% growth rate that we are assuming, if you do 200, if you put 200K in oil and gas over the length of 14, 15 years, we use conservative numbers. We just don't want to inflate the numbers here. So over the course of 14 to 15 years, you are looking at around $500,000 worth of tax savings and the cash flow that's coming out of it. In comparison to if you would have paid the taxes and reinvested the money with the same growth rate. And the case study, the number, the 499 that you're looking at, it's based on the historical cash flows that we have gotten from our partners. But it's all, the way to think about it is a portion of it, you owe that money to IRS. Either you do something about it, or you're gonna write it anyway. So I know we're on the time, Jeff. I'm not sure how much time.
No, that's great. And just to drive this home, this is not sensitive really to the growth rate, because we're assuming either that you're taking your money, paying your taxes, and investing, or that you're doing oil and gas, getting the tax savings, investing that, and then reinvesting the income after taxes from the oil and gas every year. And so if you got a higher growth rate than 8% historically, or even if you got a lower growth rate, the ordering, the benefit of oil and gas would still be positive. The bigger your return, the bigger the benefit.
And like any other strategy that we offer, where we have calculators on all the strategies that we offer, and that's why we have a calculator for oil and gas as well. Whatever you think is the reasonable growth rate based on your risk appetite, you could just put in there to see how the numbers fluctuate on your end. If you can drop the link again for a calculator, I've been asked this again, but yeah.
And by the way, just to kind of think through the implications of this, as I said, there's really, assuming historical returns from oil and gas, there's no world where it underperforms as compared to just paying your taxes. And this, by the way, is all, these numbers are after tax and after fees. So it's going to be a significant boon, assuming that the historical numbers are right, or that we outperform, which is a question.
And one thing to add here is that usually funds offer what is called a preferred return. So depending on the time of the year that you're doing, but you usually have a preferred return around 12, 14, 15% for certain years. So the fund is suppose making 20% of the profits. You will have suppose 15%, 14% preferred return for suppose 5 years, which means the fund is not going to make anything unless you make 14% a year, which means over the course of 5 years, you're making 70%. So you're going to make 70% over the course of 5 years before fund is going to start making anything. Yeah. I know we have talked about historical numbers and how aggressive that is, but that is in place, and they are confident about the fact that they're going to make enough. So they'll make profits on top of it. We can go in depth, but
no, but that's a good insight, Farhan. The fund sets their own terms, and they've decided that they are confident that they're going to get more than 14% a year over the first 5 years, so that they're going to be making money. They wouldn't have set that number there if they didn't expect to beat it. Working through a couple of quick questions here. Would S Corp pass-through income be subject to the depreciation cap? It always depends, of course, but the answer in general is no. It's business income. The W-2 portion of an S Corp income would be subject to the cap, but the business side would typically not be. Stephen asked, where can I view historical numbers and learn more? Guido, would you mind pulling up a link to the oil and gas guide? If you go to, by the way, just in general, if you go to our learning site, learn.valur.com, and just type in oil and gas or go to the oil and gas drop down in the menu, you'll see all of our articles on this. And then specifically, we can point you to this article, which is the starting point where you want to start looking. By the way, also, if you Google Valur oil and gas, you'll see this as well. But yeah, that's the place to start learning more. We include the historical numbers there. And then, as I put up a minute ago, and I'll just mention again, the easiest way to get started with this stuff is to schedule a call with us. We are available at really all times, every day, for a half-hour call with you, your clients, whoever, and we can get you deep information on this very, very quickly. And we find that's the most efficient way to do this. But start by reading, start by looking at the calculators, and if you think this is plausible for you, come talk to us. That then takes us to Yasir's question, which is, any vendors recommended? The answer is Valur. You should come to us, and we will help you then get into these investments. We work with a couple of funds. We've vetted them. We trust them. We'll share our diligence with you. You'll do your own. But the first stop is to come talk to us, and to do so as soon as possible, because although there isn't a time limit on this, you can do it in December. You'd rather get started now and start learning about this now and talking to the fund as soon as possible. So get in touch, talk with us, and we'll put you with the right people to start talking about this.
John, question. Not sure where it disappeared.
Which one were you looking for?
Yeah, John Chow. So income will come in as in K1. So yeah, usually the fund issues in a K1 before the first tax filing season. So it comes out about in March. So you will have it. So fund is going to issue you directly in a K1, which you can put it in TurboTax, give it to your CPA to file your taxes.
That's right. With 2 minutes left, let me just talk a little bit about the big picture. As I said, schedule a time to talk with us. You can always email us directly, Jeff at Valur, Farhan at Valur, support at Valur, or go to our site. There's a little chat button in the bottom right. We staff that, I'd say, probably 21 hours a day or so. We'll get back to you. Also important to note the even bigger picture, which is we've talked about oil and gas here. We've mentioned a little bit about solar, and I've dropped little hints about everything else we do. If you earn the kind of income that makes you a candidate for oil and gas or for solar, or if your clients do, then very likely it is worth thinking about the other things that Valur provides. We have other webinars, and we have, of course, our website where you can read about this. But if you're in this bracket, then very likely either now or in the near future, you should start thinking about capital gain planning. You should start thinking about estate tax planning, especially to Mike's question. What happens in the election is going to directly affect everything that we do. We'll be talking about that, as you can see here, on November 13th, about a week after, hopefully, the results are more or less known. So the point is we do a lot, and we can help in a lot of ways. So don't feel like you're limited to one solution. There's a lot of ways to save on your taxes. Keep watching our webinars. Check out our YouTube channel. Come see us on the 6th when we're talking about irrevocable life insurance trusts, which are not quite the first step, but really low-hanging fruit for families that are going to eventually be over the estate tax exemption, which, again, to Mike's question, is probably going to move over the next couple of years. As many of you know, it's scheduled to come down from about $13 million per person to the mid seven figures, kind of around 7 million, unless Congress and the president act. Depends on who wins as to what exactly is going to happen there. But come here, let's talk about that on the 6th. We'll talk about the election and the results on the 13th. And as we said, always feel free to schedule a call with us, and we will. And we're here to help you individually. So that takes us, I guess we've got 25 seconds left. Appreciate you all coming. If there are any kind of remaining questions, get in touch. Feel free to email us. But as I said, best way to get started with any of this stuff, oil and gas, solar, anything else we do, schedule a call, chat with me, chat with Farhan, chat with our colleagues. We match you with someone who's an expert on the particular subject. And we find that it's a really effective way to get started. So appreciate you all coming. Really good questions as usual. And we'll see you next time.